The stock market sounds confusing to most people. Some think it's gambling, others think it's only for rich people, and many avoid it simply because they don't understand how it works. But the stock market is not mysterious. It is a system designed to help companies grow and allow ordinary people to participate in that growth. In this video, we'll explain how the stock market works in a simple way, what stocks really are, and why long-term investing matters. No hype, no predictions, just the basics everyone should understand. What a stock really is. A stock represents ownership in a company. When you buy a stock, you are buying a small piece of that business. You are not lending money, you are becoming a partial owner. If the company grows and becomes more valuable, your ownership can become more valuable too. That is the basic idea behind stocks. Why companies sell stocks? Companies need money to grow. They may want to build new products, expand into new markets, hire more employees. Instead of borrowing money, a company can sell ownership shares. This allows the company to raise money while giving investors a chance to benefit from its success. Both sides can win. How investors make money. There are two main ways investors can make money in the stock market. First, if the company grows, the value of its stock can increase. Second, some companies pay dividends, which are small payments shared with owners. Not all stocks pay dividends, but many long-term investors value them. The key idea is this: investors benefit when businesses perform well. Why stock prices go up and down. Stock prices change constantly. This happens because of company performance, economic conditions, and investor expectations. Sometimes prices rise, sometimes they fall. Short-term movement is normal. The stock market reacts to news and emotions, but over long periods, it tends to reflect business growth. Short-term versus long-term. Many beginners focus too much on short-term price changes. They worry about daily ups and downs. But the stock market rewards patience. In the short term, prices can be unpredictable. In the long term, strong businesses tend to grow. This is why long-term investors focus on years, not days. Risk explained simply. Investing in stocks involves risk. Prices can fall, companies can struggle. But risk does not mean guaranteed loss. Risk means uncertainty in the short term. Over long periods, diversification and patience help reduce risk. Understanding risk is part of becoming a confident investor. Why the stock market matters. The stock market plays a major role in the economy. It helps companies grow. It helps people build wealth over time. Many retirement plans depend on long-term stock market growth. For ordinary people, the stock market can be a powerful tool when used responsibly. Common misunderstandings. Many people believe you need a lot of money to start. The stock market is only for experts. It's the same as gambling. These ideas are not true. Understanding the basics is more important than being an expert. Long-term investing is very different from speculation. Key principles to remember. The stock market works best when you remember a few key ideas. Stocks represent ownership. Businesses grow over time. Short-term movement is normal. Patience matters. These principles form the foundation of smart investing. The stock market is not magic. It is a system built around businesses, growth, and time. When you understand how it works, it becomes less scary and more practical. Disclaimer: this content is for educational purposes only and should not be considered financial advice. Please do your own research before making any financial decisions.